And now I just wanted to talk about option spreads. That's another strategy we use in my advisory service and in my personal trading. And again, these spread trades have done well over the last several years, despite the difficult market conditions we've had. We've had high volatility. A lot of times we've had a non-trending market. And these option spreads have done very well during these difficult market conditions. So let's just talk about the option spreads. An option spread is created when you buy and sell call options with the same expiration date. So you want to buy an equal number of options and sell an equal number of options with the same expiration date. This is what's known as a bull call spread. And you can also initiate a bearish spread by buying and selling an equal number of put options with the same expiration date. And we don't have any of these bear spreads on right now, but we did have these in 2008 and 2009 when we were in a bear market, and we did very well with these bearish spreads. So they work both ways. Right now, most markets and most stocks we're trading are in a bullish mode, so we're focused on the bullish spreads right now. But that can all change as it did in 2008 and 2009 when the major trend changed. Then we started trading the bearish spreads and did very well during the bear market. And with a bull call spread, you buy a call option and then you sell a related call option with a higher strike price. So let's say you buy the Apple 600 strike call option. If you were to sell the Apple 620 strike call option, that would create a bullish debit spread. And similar to the married put spreads, these option spreads can be done simultaneously, or you can purchase a call option at a later date. Or you can purchase a call option, then if you have a profit in it, at a later date you could sell a call option and leg into the spread. So you can buy the call, sell the call simultaneously, or you can purchase a call option, and if you have a profit at a later date, you could leg into a spread. And we do that a lot with the advisory service, and that's really helped us a lot over the last several years because once you, as you see, and you'll see in the slides coming up, once you sell that call option, the short call option profits if the underlying stock or ETF goes down in price. So that allows you to hold on to your positions because you have downside protection, and it also reduces your overall risk because when you sell a call option, you're going to collect cash in your brokerage account to help offset the purchase, the premium that you paid to purchase a call option. So I'll show you a few examples here. And with a bull call spread, the call option that you purchase profits if the price of the underlying stock increases, and the call option that you sold profits if the price of the underlying stock decreases. And the other important component of the bull call spread is your risk is limited to the cost of the spread. So whatever it costs you for the spread, if the spread costs $500, then that's your maximum risk, regardless of what happens to the price of the underlying stock. And another approach to these bull call spreads is to do in-the-money option spreads. And if you trade in-the-money call spreads, the spread can be profitable if the underlying stock stays flat or even declines in price. And I'll show you some examples of that. So if you do these spreads in the money, then you can increase the accuracy of your options trading compared to trading at the money or out of the money spread. So it makes a big difference when you do these in the money spreads. You have a much higher probability that your trade's going to be profitable. For example, today in my advisory service, we rolled over an Apple call option spread that we had, and it was doing well, so we rolled it over to the 550 and 570 strike call. So in other words, when we rolled it over, we bought the 550 strike call, sold the 570 strike call. So with Apple trading around 633, this was a very deep in the money spread, and it's going to produce a good return even if Apple price goes down, even if Apple stock goes down in price. So that's an example of how you can increase your accuracy. Apple stock would have to drop down around the 560 area before that spread would no longer be profitable. So we like to trade the in the money spreads that really gives us higher accuracy and a much higher probability that the spread's going to be profitable. So let's talk about legging into a spread. And again, if you purchase an option and that option increases in value, then if you sell a call option at a later date and create a spread, that will increase the profit potential of the existing option purchase. And it will also provide downside protection in the event the underlying stock decreases in price. So I'll show you a couple examples of legging into a spread. This is for Google, and I purchased the 570 strike call at 37.35 on October 4th. This was several years ago, and then Google went up in price, so I had a profit on this 570 strike call. So 2 weeks later, on October 14th, I went ahead and sold the 640 strike call. Google was at the time was trading at 639, so I sold the 640 strike call and at 28.65. So let's look how your risk and profit profile really change once you sell a call to protect this option purchase that you made earlier. And once I sold the 640 strike calls, I sold those at 28.65. So for each, I had 18 contracts. So each option that I sold for 28.65 resulted in $2,865 in cash being credited to my brokerage account. So that's where your downside protection comes from, and also it reduces the risk, because if I bought the 570 strike call at 37.35 and then sell the 640 strike call at 28.65, and now instead of having $3,735 at risk, I only have about $800 at risk. So that's how you reduce your risk and at the same time increase the profit potential of your option purchase. So when I sold that, 2 weeks later, when I sold that 640 strike call, I had a 33.70 open trade profit for my 570 strike call purchase. So now when I sell that out of the money 640 strike call, that increased this profit, this 33.7 profit, increased that profit potential by 85%. So I not only increased my profit potential, but I also provided downside protection in case Google goes down in price. So it's a good way to trade in difficult markets. And here's a call option spread analysis, and it assumes various changes in the price of Google stock at option expiration. And you can see the cost of this spread was $870. So I reduced my overall risk from $3,735 to $870 by selling this 640 strike call. So I reduced my risk substantially. And if Google stock was flat at option expiration, this trade had a 693% profit potential. If Google stock went up at all, it had a 704% profit potential. And if it declined 5%, it had a 325% profit potential. So not only did we provide downside protection, but we also increased the existing profit potential. And here's another example. This is for Apple. And I bought the 345 strike call at 28.17, and that was on July 8th. And then I sold the 375 strike call at 24.55 on July 19th. So 11 days later, I wanted to protect my existing profit, and I went ahead and sold the 375 strike call. So look what happens now. My total risk went from $2,817 for this 345 strike purchase to a maximum risk of $362. So that's a pretty big reduction in risk, $2,817 to $362 by creating the spread 11 days later. And here's a call option spread analysis for this trade. And again, I bought the 345 strike call at 28.17. 11 days later, sold the 375 strike call at 24.55. So the call option spread analysis shows that if Apple stock remains flat or goes up, I have a 728% return. And if Apple stock goes down 10%, I still have a 728% return. So again, reduce my risk drastically and increase the profit potential of my option purchase. And here's a spread payout graph for this spread. Maximum risk here, $362. It breaks even at around 347. If Apple stock goes up to 347, it breaks even. And if Apple stock goes up to 375, then I realize a $2,638 profit on the trade. So $2,638 profit on the trade, and a maximum risk of $362. So that's a pretty good profit potential compared to my maximum risk for this trade. Here's another example. This is for MasterCard. I purchased the 330 strike call at 23, and about 10 days later, sold the 360 strike call at 20. So now my risk goes from $2,300 to $300. So this is a great way to trade in these kind of volatile markets where you have volatile price swings, and you not only get downside protection, but you also increase your existing profit potential. So just to recap, these option spreads, the first advantage would be the sale of the call option can increase the profit potential of an option purchase by 50 to 100% or more. And we saw in the example of Google, it increased the existing profit potential by 85%. These spreads offer downside protection. and also reduce the overall risk of your trade. And again, just to summarize, that risk on the Apple spread trade that we just looked at went from $2,817 to $362, and the maximum risk on the MasterCard spread went from $2,300 to $300. And another important characteristic of these option spreads is you can maintain your positions during volatile price swings, because you do have that downside protection in place. So these have been working particularly well during the volatile markets over the last several years. In a lot of cases, these markets aren't trending. There's events overseas in Europe that can cause our market to go down, and we've had a lot of volatility, very little trend, but these option spreads have really come through for us. Here's an example of a volatile market. This is a price graph of the S&P, and over this period, the index, S&P index, was virtually unchanged. But look at these wild price swings. So in this kind of market environment, this was May of this year, as a matter of fact. So you got all these price swings, and the index is virtually unchanged. So if you're taking a directional trade in this time period, whether you're taking a long or a short trade, you're not going to do very well, because the index was unchanged, just about unchanged over this time frame. So this is the kind of markets that we've been facing the last several years. So these option spreads are a good way to go, and you can profit in these types of markets.
Chuck, if I'm correct, you actually did a webinar on market neutral strategies recently.
Yes, yes, I did. Yeah,
I believe a lot of people are going to, especially with these markets, they're going to want to hear about that. So again, for those of you at the end of the webinar, I'll tell you how you can go back and reference some of Chuck's archives and view through that. So I apologize for interrupting you, Chuck.
Oh yeah, no, that's a good point. With the with the market neutral spread, we take both a long and a short position in a market, and we profit from the time decay of the short option. So with the market neutral spread, you can make money if the market's going up or down, and that's also a good strategy in these kind of markets. So again, let's look at the advantages of simply purchasing options versus purchasing options and then creating an option spread at a later date. So the advantages of these legged-in spreads would be you increase the existing profit potential of your option purchase. The short option provides downside protection if the underlying stock or ETF goes down. You reduce your overall risk, allows you to maintain your positions during volatile markets, and the spreads can be profitable if the stock goes up or down depending on the strike prices. I just wanted to mention briefly, I'm going to show you an example here of a bearish put spread, and this was a deep in the money bearish put spread, and this was for ISRG, Intuitive Surgical. And with the bearish put spreads, I bought the 400 strike put, and then simultaneously I sold the 370 strike put. So with bearish spreads, you're going to buy a put option and then sell a put option with a lower strike price. And again, this sets up a bearish debit spread, and the most you can lose is the cost of the spread. And here's my brokerage confirmation for this trade. Bought the ISRG April 400 strike put at 70.02, sold the 370 strike put at 45.02. Now the stock was trading at 346, so this was deep in the money, this spread, and the stock would have to drop below 346 for this to even start losing its profitability. So this was a deep in the money spread, and this spread only had about 18 days to expiration. So when I put the spread on, these options expired 18 days later. Here's a put option spread analysis for this particular trade. Again, this was an 18-day trade. It had a 20% profit potential if ISRG stock drops 10%, still had a 20% profit potential, and if the stock goes stays flat, still had a 20%. If it goes up, still had a 20% return. So this was an example of a deep in the money bearish spread for ISRG. So we did a lot of these, as I mentioned earlier, we did a lot of these during the last bear market, and they really worked out well for us. So I'm just going to go through some of my real-time results here real quick, and these brokerage account profit-loss statements show these are all spread trades. It shows profits of $919,000. The average return was 58.2%. There was 130 winning trades, 11 losing trades, so the accuracy was about 92%. So this just summarizes the brokerage confirmations. I'll just go through real quick here so you can see some actual spread trading. On this portfolio, I had a $175,000 profit, average return of 95%. $118,000 profit, average return of 99.7%. So I'll just go through these quickly, but the spread trading's really worked out well for us.
You know, Chuck, what I notice is that you don't have to do 500 trades. I could see you're very focused on your trades, and there's a page full. I think a lot of people tend to overtrade, and I think your sheet showed that's exactly what you don't have to do.
Yes, yeah. Most of these, I have a total of anywhere from 6 to 10 spread trades on most of these portfolios, and I normally will do an option spread on stocks in different industries just to diversify the risk a little bit. But yeah, you're right. If you can get good diversification with 6 to 10 spread trades. And here's a snapshot of my advisory service option spread portfolio, and you can see that this has been working out really well for us. We have a $170,000 open trade profit right now, and an average return of 462%. So that's a pretty good return in these kind of markets. And some of that is due to rolling over the spread. As a matter of fact, we just rolled over some spreads today. And when you roll over a spread, if the spread is profitable and you roll it over, it reduces the cost of the new spread, reduces your overall risk, and allows you to compound your return. So that's one of the reasons why our average profit on these spreads right now is 462%, is because we do roll over these spreads and compound our returns. And that concludes my presentation for today. I'd be glad to take any questions. If you are interested in the advisory service, you can just log on to weeklyoptionalert.com, or you can call our sales partners. You can call Brad toll-free at this number. And also, if you want to look at the current profit results, just go to the website and click trade results, and it will show the current open trade profits for the various strategies. So that concludes my presentation for today, and I'd be glad to take any additional questions.
Chuck, I think a lot of people, we did get a lot of questions, and you covered a lot of them as you went along, but in today's markets, do you find yourself doing more spreads with more protective type of positions due to the fact that we don't have a lot of clarity in the concerns?
Yes, yeah, that's a good question, and you can really vary the amount of profit potential and the amount of risk with these spreads based on which strike prices you select. And as I mentioned earlier, with Apple trading at 633, today we rolled over a profitable spread into the 550, 570 strike call. So that was about 60 points below where Apple's trading right now. So that was a deep in the money spread, but we'll still realize a really good profit on that as long as Apple, closes above about 560 was our break even. So even if Apple closes at 560 or above, we'll get a really good return on that. So in these kind of markets, I like to go deep in the money with these spreads, and as you could see from the profit results, that's been a great way to go. And we've been able to hold on to these option spreads through very volatile price swings, where if we were just directional traders, we would have been stopped out. So these spreads have enabled us to maintain our positions, hold on, and then if the stock comes back in price, then we can still realize a good profit and we don't get stopped out. So it's been a great strategy for us over the last several years.
Is there any one particular strategy that you would advise our attendees today going into the election season, just maybe for protection or for a hedge? Would you maybe focus on one particular thing in your portfolio? Or you could see based on your snapshot of your service, you have various portfolios, obviously with various objectives. For the conservatives out there, would you say that perhaps covered calls and perhaps the spreads would be a good way going into the election season?
Yes, yeah, I think they would be the lowest risk rather than taking directional trades. Your covered calls and your spread trades are really a good way to go right now, and because you have downside protection built in. And one of the advantages of doing the covered call spreads with weekly options is that you get to collect an option premium every week. So we have a lot of trades where we'll collect over the course of a year by selling 52 option premiums. We'll collect 150% cash-on-cash return from our initial investment. So that's a really good way to go in these type of markets, because you're collecting that premium every week, and that really adds up over time.
So it sounds like it also adds in the flexibility, but